Hello and welcome. You tune into Rationale with me, Ankita Saxena. Well, China's central bank has unveiled its biggest stimulus since COVID. The package is aimed at offering more funding and interest rate cuts. The central bank cuts the reserve requirement ratio by 50 basis points. They are also planning to lower borrowing costs and ease the mortgage rates. Well, to weigh in on the situation, we are joined by Arnab, the macro global strategist in Invesco, and Santosh Rao, head of research and partner Manhattan Ventures. Hi, gentlemen. Thank you so much for joining us. Santosh and Arnab, both of you, thank you so much for taking the time out. Right. Santosh, I'll come to you first. China has given the biggest stimulus ever, first ever capital infusion in the country's banks since 2008. China cuts one-year rate, withdraws the cash from banking system. Firstly, how will these set of impetus impact China's slowing economy and the real estate market, as property market accounts for 30% of China's GDP?
Yeah. Good morning. This stimulus it's a short-term boost. China has much bigger problems. The drip of stimulus since 2008 has not been working, has not worked. So they figured, let's go all in, and that's what they did. But they have a trifecta of issues. They have the debt issue, they have the the deflation issue, and then they have the demographic issue. These are the three big issues overhanging Chinese economy. So there's a trifecta, and this thing in the short term, maybe it's a good thing. It'll kind of put a floor on certain things that were continuously deteriorating. So I think that's good in a way, but I think long term we have to wait and see whether this will really do it, because they have much deeper problems. The consumer is weak, the trade is weak. Everything is weak right now, and they need to hit the 5%. They're worried that they may not be able to hit the 5% GDP target for this year. So they're doing everything they can, but it's a long way to go. This is a good start, but it's not going to solve all the problems.
Right. Let me bring in Arnab also. Arnab, do you concur with Santosh that this is not going to solve the problem in the long term? It's just a short-term measure, and China may not be, after all, be able to hit the 5% mark on their GDP.
Well, look, thanks for having me back again. Good to be here. I think I agree in part. I think what's changed is that there's a message here, as well as some money and some changes in monetary policy, some signals about changes in fiscal policy, that is quite a bit different than what was taking place before, where there was kind of at best benign neglect. So I think that is an important change of tone. Now, having said that, and an important change of policy as well. Now, having said that, I agree there are some important structural challenges. There's also, possibly more to come to deal with some of those structural challenges. I think there are some constraints as well. I think they don't want to fully reflate the housing situation, because whether like you were saying, is 30% of GDP, some estimates put it somewhat lower or significantly lower, but still most estimates are quite high that residential real estate accounts for 20-30% of GDP, which is arguably unbalanced and, quite too much for such a large economy to be so dependent on one sector. So I think, it sort of makes sense to put a floor, but not necessarily to try and, go the whole 9 yards and really reflate property bubble that's associated with a lot of debt, whether it's mortgage debt by the households or property developers' debts or challenges, like you pointed out, that might be in the banking system that require recapitalization. So I think they're doing things to put this to put a floor under this situation in the context of those issues, in the context of what might be coming down the pipeline from the tension with the U.S., particularly if President Trump is reelected. There might be a significant wave of tariffs. So it makes sense to keep some powder dry for that. And of course, there's, as was already mentioned, these three Ds. There's the demographic challenge. Perhaps you don't want the whole economy to be, or so much of the whole economy to be, about housing, already unaffordable for many parts of the population, particularly younger people, to be even more of a speculative frenzy and maybe overbuilding housing for a society where the population is aging and shrinking eventually.
Right. So, Santosh, the Chinese market, is that likely to be a more attractive destination for the FIIs, given that Indian markets are fairly expensive now? That, or given what you've just mentioned, that there's still a long way to go for China, is that not going to be the case? Are FIIs more inclined towards India? Because of the weak Chinese market, or is it that at this point Indian markets are a little expensive and the Chinese market become more attractive after this impetus?
Yeah, I think India is still a net beneficiary of any weakening in China. So this will maybe a short-term boost to whatever people are looking at, the traders especially. But long-term investors, I don't think are really comfortable with everything that's going on there. First of all, it's a very erratic regulatory regime there, and they don't want to risk that capital in there. So I think that's an overhanging issue that has not been resolved. Yes, it's good in the near term. Maybe a few internet stocks here, technology stocks will get a slight bump. But in the long term, serious money is not going to flow into this till we see some real, because we've had three times we've had stimulus in 2008, 2015, then during COVID, and it has not worked because it's really been like very abrupt and very stimulus, very targeted and all that, but it wasn't working at all. So I think people are going to wait it out. They're going to wait and see what happens. Yes, if you're looking for a bottom, maybe you can get in, but it's going to take a while before they really go up. So FIRs will continue, and foreign money will come into India more so. Yes, India is expensive, but India has a higher growth rate, much more stability, and all that stuff. So I think they will prefer India to China. But this is, don't get me wrong, it is good. We need China in the game. It's the second biggest economy. So this kind of helps in that sense, but it doesn't resolve everything. In the near term, the other emerging markets will be net beneficiary of money flowing into their markets.
Right. Arnab, what's your take on the fact that FIIs might, still see India as an attractive destination for investment and as the strongest emerging market, despite China trying perhaps everything to stimulate the economy?
Look, I think the point that you and Santosh as well make about the valuations is very important. I think the valuations are seen as eye-watering in the case of India. But having said that, I tend to agree. I think the story in India is quite strong and quite positive. The demographic situation is helpful. The regulatory situation is helpful. Um, Earnings, income, and the household sector are growing and being financialized when it comes to savings, much of which is finding its way into the equity market. And so, my impression is that Indians love their own stock market, whereas I suspect that Chinese people have suffered some losses both in the household sector and in the equity market, and so they may not put as much of their own money to work in either of those markets as is being the case as is the case now in India. And I think foreign investors will look at that entire situation and take cues from that. So I think they will, worry about the excessive valuations in India, but continue to come in. And I think they will look at China as an opportunity. There's been an important correction in that undervaluation in China, but they'll continue to look at it to see if there's more follow through, more fiscal, more support coming, and what exactly is it that occurs in the relationship between U.S. and China, on which I think India is relatively hedged, right, relatively well protected from tensions with the U.S. Of course, there are tensions with China, but it's unlikely that there's going to be anything but continued good relations, probably improving relations between India and the West and the U.S. in particular. So I think geopolitically that probably also will benefit India, continue to benefit India.
Right. Santosh, so what does it really mean for the crude oil prices? Now, crude prices have been declining, and China is the biggest importer of crude, and the prices can only rise if China's economy and demand really resurrects. Is there now a possibility that there is going to be some kind of a reversal in demand?
Yes, I think crude has been a real anomaly here, crude price especially. We have so many geopolitical events, the geopolitical events going on literally, and that could potentially disrupt the oil flow. But it's been a steady increase or steady, it's held its base essentially. But what's going to happen now is China coming into this thing. Yes, it's going to stimulate some demand in there. But I think the wild card is that US production is big and the supply side of the equation is still secure. So I think at best, maybe I was following our oil analysts and all that. I think prices may go up another $10, so maybe in the 70 to 80 range, but not by much at least, because there's tremendous supply in there, and the geopolitical events have not really disrupted anything. But the wild card again is if Iran gets into this thing and just kind of jacks up the whole conflict, then maybe oil prices will get impact. But other than that, if it continues at this rate, I think oil prices will benefit definitely slightly. China coming in is net positive, of course, but it won't be out of the park because there is enough supply to take up that demand.
Right. Arnab, coming to you then, speaking of the metals then, Indian metal staged a recovery today, after hitting a low, and of course that's coming on the back of the recovery stimulus by China. Going ahead, how do you see that panning out in the metal pack?
Yeah, look, I think there are tailwinds for commodity prices, perhaps other than gold, because of the supply response from the U.S. and also Saudi Arabia has come in with supply on oil. In the rest of the commodity space, industrial commodities and base metals, I think it sort of makes sense that some stimulus in China that puts a floor under the housing market and the markets generally in China maybe does impart a boost to growth. And even if the 5% growth target is, somewhat challenged, moving in the right direction towards it, that's got to be good for global growth and good for emerging markets that are producers of those metals, and indeed for the metals prices themselves. So I think that's the particular dynamic, and I don't think you have in the metals market the kind of concentrated supply response sort of thing that's happening in the oil market, right? So Saudi Arabia has stepped up or plans to step up its output of oil. So you have this overhang of potential geopolitical risk that could drive the oil price up. They're trying to offset that to some degree by ramping up production. And the U.S., of course, is now energy self-sufficient and even an energy exporter, plus Russia is pumping plenty of oil. You don't have those kinds of dynamics in parts of the metal sector, in most of the metal sector, and other industrial commodities or soft commodities, really, right? It's really mainly an oil story. So I would say I think this is positive for the outlook for global growth, because China is coming back into the game, as was said. And therefore, that should be supportive for commodities, especially at a time when the U.S. is easing and the dollar is softening, which generally tends to boost commodity prices.
All right, Arnab and Santosh, thank you so much for taking the time out and joining us today and weighing in on this. Thank you so much, gentlemen.
If you like this video, then like, share and subscribe to ET Now.